The federal government just announced significant changes to mortgage rules in Canada, and if you're someone who's looking to buy your first home, they're hoping they've just made it easier than ever for you to do that. But I'm not so sure if that's actually going to be the case. Let's jump into it. In this video, I'm going to explain what the new rules are, how they're going to impact the housing market, and what the implications might be for you in your own home buying journey. So the two big rule changes are an increased price cap for insured mortgages and a longer, more extended period of amortization available. The price cap on insured mortgages is increasing from 1 million to 1.5 million, a massive jump. And first-time home buyers can now opt in for a 30-year amortization period on any type of home purchase. And aside from just the first-time home buyers, any buyer of any type can also access these 30-year amortization periods on any type of newly built home that they're looking to buy. These changes are set to kick in on December 15th, but what do they mean for you? Let's break it down. So before these rule changes, if you wanted to buy a home greater than $1 million, you had to put a minimum of 20% down on that purchase. Now with the new rules, homes priced at all the way up to 1.5 million are eligible for mortgage insurance, meaning that you can put as low as 5% down on the first $500,000 of the home and 10% down on the remaining up to 1 million. Effectively, this lets buyers put down a smaller down payment in order to get a big, expensive home. Although not that big if you're living in somewhere like Toronto or Vancouver. So as an example, if you live in a city like Toronto where the average home price right now is about $1.08 million, with the current rules in place, you'd have to put a minimum down payment of at least $216,000. Now with the new rules, it'll probably be somewhere closer to $83,000 as the minimum amount you'd need to put down to get that average home. And that is a massive cut, a massive decrease in the amount you need to put down. And next is the extension of amortization periods from 25 years to 30 years. So if you're a first-time home buyer, you now have access to 30-year amortization period mortgages, meaning you can spread out the payments of your mortgage over 30 years instead of 25 years, which will decrease your monthly mortgage payment. And for all buyers, not just first-time home buyers, if you're looking to buy a newly built home, you'll also have access to the 30-year amortization periods. So let's say you're a first-time home buyer looking to purchase a home that costs $650,000 with a 10% down payment. With a 25-year amortization period and an interest rate of about 4.09%, your monthly mortgage payment would be around $3,198. But with a 30-year amortization period, your monthly interest rate is dropping down all the way to $2,895, nearly $300 less per month in mortgage payments. So what does this mean for you as a potential home buyer? Well, the lower monthly payments from the longer amortization periods means you can afford a larger mortgage. And the ability to get mortgage insurance allows you to reduce the upfront costs involved in purchasing a home that costs more than $1 million, making a whole new set of price ranges accessible to you. Meaning that with less money upfront, you can now get much bigger and nicer homes. But in my opinion, it's not all sunshine and roses. There's a lot of long-term implications here, and let's look at some of the trade-offs. While having a lower monthly payment sounds great, you're significantly increasing the amount you're going to be paying in interest over the lifetime of the mortgage. Using the previous example, the total amount of interest you'd be paying over a 30-year amortization period is about $440,000, compared to about $360,000 if you had selected a 25-year amortization period. A difference of nearly $83,000. It's massive. As well, having access to a larger mortgage creates the opportunity for a lot more risk. If you're taking on more debt, if things like interest rates change again in the future, if your personal financial picture changes, you're increasing your risk greatly with the much larger mortgage. So how are these changes going to impact the housing market overall? Well, now with a lot of home buyers having access to larger mortgages, they can put offers on more and larger houses, therefore increasing demand in the housing market and probably driving up prices more. And applying the 30-year amortization period availability to newly built homes for any demographic of home buyer, the government's trying to say that that's going to increase the supply of newly built homes because there's now greater demand for them. We'll see if that ends up being true. And allowing home buyers to take on significantly larger amounts of debt increases their overall household debt, which just introduces a lot more risk into the Canadian economy as a whole and can have a lot of negative impacts and consequences, especially if the economic situation changes or interest rates change. And while the longer amortization periods allow you to have lower monthly payments, with the increased interest that you're paying over that time, in a way, these houses are actually becoming more expensive when you start looking at those really long drawn out amortization periods. Now, the way the government is selling this proposal is, hey, they know a ton of people can't afford to get their first home, and they've got a big election coming up, maybe this year, most likely next year. And so they're throwing anything they can at the wall in order to make young Canadians feel like they have the opportunity to buy a home. And while this does make it easier for first-time home buyers to buy a home, it actually sets them up for a much worse financial picture in the long term. And really, if you zoom out, the housing crisis that Canada is facing is a supply side issue. There's not enough homes for the growing population, and there's not enough skilled laborers to build and keep up with demand. These sorts of policies ultimately look more like demand side measures of creating more demand by having more younger, usually first-time home buyers being able to bid on homes on the lower end of the market. Now, the government's also saying we're updating the mortgage insurance rules because we haven't updated them since 2012. Back in 2012, $1 million home was a lot different than it is today. So 1.5 million is just keeping up with, inflation and the increase in the market and just the overall changing economic picture. And the government's argument that, hey, this is actually supply side because allowing the 30-year amortization periods for newly built home purchases of any type of home buyer is going to drive up demand for newly built homes. That could possibly be true, but if you don't increase the labor that's available to build new homes, it's hard to see if it's going to have the impact and the actual new increase in housing is going to take place. So what's my take here? It's pretty clear that Canada's housing crisis is mostly a supply side issue with Canada's fast growing population and lack of skilled workers to build houses. The price of homes are just going to go up and up. And as they go up and up, a lot of people who own homes are treating it as their nest egg. So the federal government can't really do too much to bring down the price of houses because then you start screwing with people's retirement plan. And that's a big no-no. So they're in a really tough spot. And I think a policy like this is a good feels nice policy. It feels nice. It feels like homes are now more attainable, but you're probably going to see an increase in home prices as a result of more people bidding on these homes. And also, like I said, these 30-year amortization periods and these lower down payment mortgages significantly drive up the amount of interest you're going to be paying over the lifetime of the mortgage. So while it may be easier to get into that first home when you're in your 30s, when you go down the line and you get into the later years in life, you'll have spent tens of thousands more in interest than you would have, which could set you up great for retirement if you had that money. So my main takeaway here is that there is really no have your cake and eat it too result from this policy. Either you put yourself in a more pleasant living situation by getting that first home more easily, but setting yourself up for a worse long-term financial picture by paying way more interest over the lifetime of the mortgage. And the housing crisis, I don't know if this significantly magnifies it, but it definitely doesn't solve the supply side problem, in my opinion. But you and I will both find out what actually happens when this policy goes into place on December 15th. I'm Calvin Crotchlow. Thanks for watching this video. Have a great day.